All right then, good morning everyone as we head into US inflation today on Wednesday, the 10th of April. We'll have a quick flick across inflation, we'll have a flick across the Bank of Canada and see what we're expecting a little bit later on today. You can see at 1:30 today we do have US inflation. We have obviously the core prints and then the headline prints. Now, a lot of these are expected slightly lower than previous. So you can see the core inflation rate or core CPI. I don't know why it says inflation rate on this calendar, but obviously it's core CPI. Below consensus, or below previous, consensus 0.3. Year over year figure for the core print 3.7 versus the previous of 3.8. You can see CPI, obviously once you include food and fuel costs, consensus minus 0.3 or 0.3, not minus 0.3, below the 0.4 from the previous one. But the headline figure expected to jump from 3.2 up to 3.4. Now, you kind of have a look at what to expect then going backwards. I mean, have a look at these, where we at, Thursday. You have a look at this PPI print from last month. Now, PPI over January 0.3%, PPI over February 0.6%. Right, that is a contributing factor to inflation, and something we do need to keep in the back of our minds. We then obviously have CPI today. You can have a look at these prints. Going back, we've had 0.4% in January, nearly 0.4 rounded up to 0.4 in February. So quite strong inflation over the course of this year. You can have a look at the total rate of inflation. We see 0.3 in January, 0.4 in February. So inflation has started to tick back higher over the course of this year. Now another 0.4 prints on both of these kind of put paid 20 thoughts personally, I think, of any interest rate cuts come June. Markets still expect 3 or still have 3 priced in. They're kind of waking up slightly to the fact that I'll get those 3 cuts. Last week we had Neil Kashkari, Minneapolis Fed, suggesting we may not even get any cuts this year. It was, historically known as a bit of a dove. You then have Bostic, who overnight suggested we may only get 1 cut through to year end, who again is historically noted as a bit of a dove. So, kind of differences of opinion from them compared to what the dot plots are telling us. But no chance of an interest rate cut in May. We can forget about that. We then go on to June, and it's pretty much 50-50. You can see that's jumped, though. From a month ago, no cut was 26%. Now it's up near 50. In terms of the pricing for a cut, it was also at 57, then up to 61 a week ago, now back at 50%. So your market's kind of starting to price in the fact we may not get a cut in June. This inflation print, I think, gives us a pretty clear answer as to whether we will get one in June. Now, we do still have 2 inflation prints between now and that print, but we do obviously have the one in May. What happens then to the one in June? That's likely to be a day or something before the Feds. We can't really react off that June one for the June meeting, right? But then if this comes in higher than anticipated today, right, why does it come in higher than why might it come in higher than anticipated today? You got inflation, has been strong in terms of the actual inflation print, CPI and PPI. You've also got, if you look over here, look at commodity prices this year. You look at gold, you look at silver, you look at copper. We all know what's going on with things like cocoa, right? You then look at oil, crude or WTI, and then you look at Brent, and then you look at the commodity index provided by Reuters, which is a basket of 17 different commodities and ETFs and stuff. Again, that's just been ripping higher over the course of this year. Commodity prices are a contributing factor to higher levels of inflation. You then look at the actual inflation prints, they are higher. You then look at economic data prints that have been strong over the course of this year and continue to be strong out of the US. You look at the S&P with their manufacturing PMI suggesting that underlying price pressures throughout different sectors of the economy have risen over the course of this year. All those things point towards higher than anticipated inflation. You've also maybe think a bit cynical about it. I mean, the central banks are all buying gold globally. Are they buying gold? A bit of a hedge against inflation? I don't know. Maybe I'm not going to think too much about that really when it comes to this. So, what that then does potentially for the price of, interest rate pricing come June, if we do get that higher than anticipated print, it will cause this to be repriced. If this gets caused to be repriced, yields then, if you have a look at yields should then reprice higher, equities should then reprice lower, and obviously if yields are higher, that's essentially interest rates moving higher, makes the dollar a more attractive proposition, to put it basically. And then that will cause some broad-based US dollar strength. If that then does happen, right, you got to look at these currency pairs as to which one to hit, right? The Kiwi dollar, you look at the RB&Z this morning, kind of more hawkish than dovish. They're certainly not opening the door up to interest rate cuts. saying they need to keep policy at a restrictive level, and need to continue to keep it at a restrictive level for a little bit of time yet. So I wouldn't say Kiwi dollar is a possibility for or in that eventuality. Then look at dollar yen up at the potential intervention level. You don't want to be getting long dollar yen on a break above that. That kind of could potentially cause you some troubles if the Bank of Japan go in and then decide to intervene. You've got Australia, right? Chinese economy isn't performing well, as we all know. You've got the RBA, you've got interest rates lower than a number of the other central banks, or most of the other central banks. You've also then got, Fitch downgraded China's credit rating overnight, and then if you do get a higher than anticipated print, it should cause equities to move lower, which that's a recipe for a pretty good sell on the Australian dollar. Euro dollar, they're likely to need to cut interest rates quicker than the majority of the rest of the central banks, so I think euro is a good one to sell, potentially into the ECB tomorrow. We're not expecting much out of the ECB tomorrow, which is a bit unfortunate. If this was their May print, we might get a bit of action then short some euro dollar, but it might be a little bit of a tricky one. Rate cut expectations have been brought forward in the UK. I think that sentiment has kind of waned, so I'd probably rather Aussie and the euro over sterling, but sterling it might not be a bad sell. I'd certainly avoid Kiwi, dollar yen. Dollar CAD, you got the Bank of Canada, which I'll talk about in a minute, and dollar Swiss with their surprise interest rate cut a week or two ago, or a couple of weeks ago. That then is a situation where you should go long dollar Swiss. So Aussie Kiwi or Aussie and euro shorts, dollar Swiss longs is kind of the trades of choice. On the flip side, I mean, I suppose you have gold. Gold surely is a very heavily net long asset at this point in time. So the fact that gold has risen higher at the speed that it has done, with the US dollar strength, gold short would probably be a pretty good idea. But at the end of the day, gold can be seen as a hedge against inflation. So I think long some dollars across those currency pairs would be a better option. If this comes in lower than anticipated, right, and it sparks a bit of a kind of risk on rally, if you want to call it that, and markets are kind of accepting of the fact that you may not get or that you may actually get a number of cuts this year, I think markets will probably get ahead of themselves in that eventuality and start to get excited. If that then happens, short or long equity, should I say, off the back of a lower than anticipated inflation print, right? Lower than anticipated inflation probably will cause markets to overreact slightly. That then is a situation where you can go long equities, I think. So higher than anticipated inflation, you want to be probably short Aussie or euro, maybe long dollar Swiss. Lower than anticipated inflation, you want to be long equities. As I said, markets may get a bit ahead of themselves, but that is the eventuality from a couple of different scenarios. What I'm personally hoping for, where I think you get the bigger move, is on a higher than anticipated inflation print that will cause markets to become even more worried about whether we get those cuts or not. I absolutely would not be surprised if we didn't get any cuts this year. I certainly don't think we'll get three. Higher than anticipated inflation print confirms that, gives us the best tradable opportunities, I think. Is it the best for people and best for the economy? No, probably not, or absolutely not. But again, we're not in the business of hoping the economies perform well. We're in the business of trying to make some cash from financial markets. So that's where I think the best tradable opportunities come from. You've then got the Bank of Canada. Right, the Bank of Canada at their last meeting did not take any steps towards cutting interest rates. Right, they said it was a bit premature. They needed to see more progress on inflation. Since that last decision, we have had more progress on inflation. They've now had 2 consecutive inflation prints below that 3% target that they obviously target. That is more progress on inflation. You've missed consensus to the downside on both of the last couple of prints, so more progress has been made towards inflation. That is a step then towards opening the door for interest rate cuts. Whether they actually go and do that with higher commodity prices, higher oil prices, I mean, I could understand it if they went and did some kind of reverse jawboning, if that makes sense, and kind of tried to at least talk a bit more of a hawkish game and not give markets a bit of a fresh impetus to go and kind of sell the Canadian dollar, or buy the Canadian, not give markets a bit of fresh impetus with the potential for interest rate cuts to cause further inflation in the economy. So I mean, in reality, they probably can go and talk about interest rate cuts, which is an easy sell of the Canadian dollar, because that will be the first time that they will do it. If you think about it logically, though, it would kind of make a bit of sense for them to just hold off on that a little bit while you have commodity prices where they are while inflation is rising in the US. and that would maybe be slightly prudent from them. But you know, if somebody was to put a gun to my head and say trade that short Canadian dollars off the back of a dovish Bank of Canada, would be my preferred choice. Again, that's what you would expect and that's what you would hope for, but I can understand it if they go the other way. If they do go the other way, I'd imagine markets will probably look past that and sense that that's kind of what they're trying to do, because inflation is back within their target. There's no need for them to keep talking a hawkish game, other than the fact commodity prices are rising, and it may put a bit of upwards pressure on inflation. So probably they'll come out a bit dovish, but I can absolutely understand if they don't. I wouldn't go looking to be long the Canadian dollar off the back of that. If they do talk about interest rate cuts, short the Canadian dollar is a good bet, I think. Right. That's how I'm kind of thinking, or that's my thought process into inflation in the Bank of Canada a little bit later on. We'll update as and when we get some fresh information now. But best of luck if you're going to go and try and trade it. Get stuck into it if you can. Obviously, if you don't get what you're looking for, well then stay out of markets. Normally when you get a highly anticipated print like this, it comes in line with consensus, and yeah, nothing to see here. But we'll cross that bridge when it comes to 130. Best of luck out there if you're trying to trade it. And yeah, we'll see how we get on in a few hours' time.